Happy Friday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. Let's jump in. And first up, we begin in Europe. Eurozone industrial production fell sharply in August, once again showing persistent fragility across the bloc's manufacturing sector as firms grapple with shifting global trade patterns and growing geopolitical risks. According to Eurostat, output in the 20-nation currency area dropped 1.2% from July, reversing a 0.5% rise the previous month. Although the decline was less severe than economists' expectations of a 1.6% fall, it marked another sign of weakness after a volatile year for Europe's factories. Industrial activity surged early in 2025 as manufacturers rushed to fill orders ahead of new US tariffs on imported goods, but momentum has since faded. Quote, prospects for industry remain poor for the foreseeable future, end quote, said Andrew Cunningham, chief Europe economist at Capital Economics. He noted that Eurozone growth in 2025 has largely been front-loaded with little expansion since spring. The August slump was led by Germany, where output plunged 5.2%, hit by summer shutdowns, high energy costs, and mounting Chinese competition. Italy and France also recorded declines, while Ireland saw strong but volatile gains due to its exposure to US tariff policy. Production of durable consumer goods and capital equipment, longer-lasting products vital to investment cycles, fell most sharply. A concerning development. The data reinforced the view that the Eurozone's economy barely expanded in the third quarter. Analysts warn that without a rebound in industrial momentum, growth could stagnate into 2026. Compounding Europe's industrial woes, China's new export restrictions on critical minerals have reignited alarm among European manufacturers and defense firms alike. From the 1st of December, Beijing will restrict exports of rare earths and related technologies to any entity connected with foreign militaries, effectively blocking such materials from reaching Western defense supply chains. Experts warn that the restrictions could disrupt production of ammunition and high-tech defense systems, further straining Europe's rearmament drive. The twin pressures of industrial slowdown and strategic resource dependence underscore the urgency of the EU's Critical Raw Minerals Act, aimed at cutting reliance on China and building resilient supply chains as Europe confronts a new era of economic and security uncertainty. However, even if they move at warp speed, this transition is going to take some time, and as regular viewers of the channel know, many of these economies in Europe simply do not have that much fiscal room and are operating at a time where voting populations are not sympathetic to the state of affairs. Next up, we move across the Atlantic to North America. JP Morgan Chase & Co.'s third quarter results revealed more than a one-off loss. The $170 million charge-off tied to the collapse of subprime auto lender Tricolor Holdings has rattled Wall Street and revealed long-dormant fears about hidden weaknesses in US credit markets. Quote, when you see one cockroach, there are probably more, end quote. Chief Executive Officer Jamie Dimon cautioned on Tuesday's earnings call, suggesting that Tricolor's implosion may be a harbinger of further trouble ahead. Tricolor's bankruptcy marks what Dimon described as, quote, not our finest moment, end quote, for the New York-based bank, which has since launched an internal review of its lending procedures. The auto financier's downfall following the recent bankruptcy of auto parts supplier First Brands Group underscores a growing sense of unease about fraud, risk controls, and excess leverage in niche lending sectors. Quote, there clearly was, in my opinion, fraud involved in a bunch of these things, end quote, Dimon said, adding that even the largest banks, quote, make mistakes too, end quote. The unease quickly spread. Within days, regional lenders Zions Bancorp and Western Alliance Bancorp disclosed new credit problems involving alleged loan fraud tied to investors. Zions took a $50 million charge-off after discovering the collateral for loans made by its California Bank and Trust unit had been transferred to other entities. Western Alliance fell 11% after revealing similar exposures, and to the same borrowers, compounding fears that a broader pattern is emerging. Both banks declined to comment, while the borrower's attorney called the accusations unfounded. While the losses disclosed by regional lenders were modest compared to Tricolor's or First Brands' multi-billion-dollar collapses, the market reaction was swift and severe. Shares of 74 major US banks shed more than $100 billion in value on Thursday, yesterday alone. Analysts at JP Morgan noted that investors, quote, sell first and ask questions later, end quote, whenever credit events cluster like this. The question, they wrote, is, quote, why all these credit one-offs tariffs are seemingly occurring in a short period of time, end quote. For now, there are signs the damage may be contained. JP Morgan set aside $3.4 billion in provisions for future losses, but its 5 closest rivals collectively reserved the least in 2 years. And Morgan Stanley added nothing at all. Even so, Dimon's warning hangs over the industry. As fraud allegations mount and bankruptcies pile up, the search for the next Cockroach has only begun. Now, if you want to continue to be on top of all things markets, economics and finance, and the world's most important markets, consider subscribing to Market Update. Hit the bell notification icon and you will be. And if you're getting some value from today's episode, don't forget to hit the like button. And finally for today, Washington's tariff offensive is hitting Indian exporters hard, even as New Delhi races to diversify its trade relationships and keep its economy steady. Government data released Wednesday showed Indian goods exports to the United States plunged 20.7% month-on-month in September to $5.44 billion, following a 14.35% drop in August. The collapse came after Washington imposed a punitive 50% import tariff, one of its steepest, on Indian goods in retaliation for India's continued purchases of Russian oil. The tariffs have made Indian products uncompetitive in the US market, forcing American buyers to demand steep discounts and squeezing margins for Indian suppliers. Yet despite the slump in its largest export destination, India's overall goods exports rose 3.6% in September to $36.38 billion, buoyed by robust demand from other regions. Imports jumped 11.3%, widening the trade deficit by over 21% to $32 billion. Economists say the shift underscores India's effort to pivot away from over-reliance on the US. Quote, the export orders increased at a faster rate in September, indicating demand outside the US might be offsetting the decline from tariffs, end quote, said the chief India economist at HSBC. She added that business confidence rose sharply last month, reflecting optimism over tax cuts and new demand drivers despite US headwinds. Some commentators point out, however, that India may still be sending stuff to the United States just through other countries. This is called transshipping, and it has been well established as a practice that China now uses to achieve similar ends. Trade frictions with Washington have deepened since the US President Donald Trump accused India of, quote, fueling a war machine, end quote, through discounted Russian oil purchases. New Delhi's refusal to curb Russian imports or open its agriculture or dairy sectors to US producers has stalled talks. Relations were further strained after Trump claimed to have mediated a peace deal with Pakistan in May, something India denies occurred. Still, there are signs of a thaw. A US delegation led by the Assistant Trade Representative for South and Central Asia met Indian negotiators in New Delhi last month. India's new Commerce Secretary said talks in Washington this week aim for a, quote, win-win solution, end quote, to resolve the tariff impasse. At the same time, India is pressing ahead with broader trade diplomacy. It signed a landmark UK trade pact in July, is finalising an EU trade deal, and is reviewing its FTA with ASEAN, the Association of Southeast Asian Nations. The government hopes to conclude the US agreement by November. Trump's conciliatory tone, calling Prime Minister Modi, quote, a very good friend, end quote, this week, and recent meetings between both nations' trade teams has helped sentiment. The currency surged nearly 1% on Wednesday on hopes of progress, yet India's balancing act between Washington and Moscow remains precarious. Refiners are reviewing Russian oil purchases, but see no immediate halt. For now, India's strategy is clear: diversify markets, preserve energy security, and wait for the storm to pass. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Friday, have a restful weekend, and I hope to see you for a new week of updates on Monday.